Hi folks, Chuck Gibson for Financial Perspectives with October 2017's Charts on the Move. I want to make this a short video as there's nothing that's really changed from last month. While some individual stocks have been hit and hit hard, the markets are still in an uptrend, and as of now, there's nothing telling us otherwise. It's not just stocks that are rising though, because we see the Bloomberg Commodity Index rose to an 8-month high. The base metals ETF reached its highest level in the last 4 years. Brent crude oil exceeded $60 a barrel for the first time in 2 years. And West Texas crude is testing overhead resistance at $55, and it looks as if it may be the next to break out. And of course, the energy stock ETF is approaching a 6-month high. It appears as if the market is pricing in the chance of the I word. That's inflation. It's going to be interesting to see after many years if this is the real deal or just another sucker rally. I gotta say, this is one of those rare times when the opportunities are so plentiful that I find more ideas than I have money to invest. But hey, that's the hallmark of a strong bull market. We need to be thankful and take advantage of what the market is giving. But we also have to be aware we cannot become complacent because all bull markets eventually end. With no real changes from last month, I thought I'd take the opportunity to show you a view of the markets from a different angle than I normally show. What you're used to seeing from me are weekly and daily views of the markets. As you know, I use the weekly views to define the trend, and then the daily views, and sometimes even shorter term time frames such as hourly, in order to optimize entry and exit points. The shorter the time frame, the more wiggling and noise in the chart. Extending the time frame adds a filter and it smooths out the bumps, making the chart much easier to interpret. What I find helpful sometimes is to push the time frames even longer than the weekly period, and look at the monthly charts to ensure that they're providing the same message as those viewed on shorter time frames. So, the remainder of this video, that's what I'm going to do. Present you a 10-year, where possible, monthly look at a few key US and global markets. Let's see if that doesn't help making viewing the markets a bit easier. Let's get to it. My first chart is that of the US S&P 500 stock index. Does the longer term view here make it easier to see the existing trend? Notice how the last 8 months and 12 out of the last 13 saw the index close at a higher price than it had seen in the prior month. As of now, price is comfortably above its rising 200-day moving average in this blue 9-year uptrend line. As you can see, RSI momentum is massively overbought. In fact, it's the highest it's been over the last 10 years, which is a tad bit disconcerting. Overbought is good. Massively overbought is a warning of the eventuality of a correction, or at least a consolidation. But because each candle represents a month in time, this eventually could turn out to be years from now before any correction actually materializes. The NASDAQ 100 Large Cap Tech ETF looks very similar to the S&P 500, with the notable exception that RSI momentum, while very overbought, is not at its highs. Like the S&P 500, it's in an uptrend, making higher highs and higher lows. It also sits above both its rising 200-day moving average and its 9-year long uptrend line. Until that changes, investors would be best served not to fight it, no matter how crazy this market seems. Moving around the globe, my next chart is a basket of European stocks. It shows that while they too have been in an uptrend over the past 9 years, the path has not been quite as smooth as their US counterparts. As such, they just recently broke out to all-time highs here, while most US stock indexes did so many months ago. Price sits above a rising 200-day moving average, while RSI momentum has just recently reached overbought conditions, providing it a lot more room to run if it wants to. My next chart, a basket of Asian stocks, has more closely followed the European path rather than those of US stocks. While up handsomely from the bottom, its climb has also been a choppy one, as almost 7 years of this 9-year bull run was spent in this sideways consolidation. For those wondering, this is the norm, not what has occurred with US stocks. Studies have been done which showed that markets, on average, consolidate 60 to 70% of the time and trend the rest. So what that means is 60 to 70% of the time, your investments are not making any money. So patience in sticking with the trend is an investor's best course of action. The next chart of emerging market stocks show how late they are to the all-time high party. Like Asian stocks, a quick and steep ascent from its 2009 low, followed by an extensive 7-year period of sideways chop. Hopefully it's obvious that owning European, Asian, and emerging market equities during their 7-year consolidation and before their recent breakouts has earned investors little to nothing, maybe even a loss depending upon where they entered into the position. This is as clear as day when looking in the rearview mirror. The fact is, since 2009 bottom, having a diversified portfolio has severely underperformed a pure US-centric portfolio. It looks like this may be changing, but trends tend to last a long time and as such take a long time to reverse. This is a great example of why investors need an investment process that has a way to measure and capture investments with greater relative strength, as that is the way to outperform a diversified portfolio. Moving away from equities and switching to the US dollar, you can see we're currently in the middle of a longer term uptrend while stuck in an intermediate term 3-year consolidation. RSI momentum became massively overbought here and has since fallen while price has risen, which forms negative divergence. These divergences are often the precursor to pullbacks, where one could expect to see a lower low. As you can see, this is exactly what had already occurred right here. This blue horizontal support line is the line in the sand for the dollar uptrend. Bulls want to see price remain above it. Any break and hold lower, that line of support turns into resistance and will be my signal that we've reached the end of this uptrend and the bears have won the battle. My last chart is that of gold. I can't ignore my gold bug friends. The longer term view makes it easy to see that while it was in a downtrend from 2012 through 2015, that downtrend has now since turned into a sideways consolidation. A break above this blue horizontal level would be a constructive buy signal for the shiny metal, as it will have created a higher high and a higher low. Those are a must-see before any new uptrend can be declared. There is no reason to commit investment capital to any investment until it has entered into a clear and defined uptrend. For anyone having doubts about this market, hopefully viewing all these charts on a monthly time frame gives you a little comfort that there is no sign of yet that this bull market is toast. That doesn't mean it can't change tomorrow, but the bottom line is equities continue to make all-time highs, and the outlook into year-end is very favorable. Short-term studies like the Fear and Greed Index and the volatility term structure suggest a lower close next month ahead, but any weakness, if it occurs, is likely to be temporary. Since it's likely I won't get a chance to talk to you before then, I want to take this time to wish everyone a happy Thanksgiving and, of course, Black Friday. Until next month, as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or any comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with October 2017's Charts on the Move.